Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
This is ETF Market Insights. I'm Danielle Neziol with BMO ETFs. Today we have Matt Montemurro here with us as well. Matt is a portfolio manager with BMO, but an overall ETF expert as well. Matt, it's so great to have you on the show again.
Thanks for having me, Danielle. I'm looking forward to it.
As a reminder, Matt and I today, we're not providing you any advice. We're not providing you any investment recommendations. Today's episode and everything we publish on our channel, it's all about education to empower direct investors to make investment decisions that are right for you and your own unique investing needs. Now, Matt, I think we have a very hot topic today. I wanted to get in front of investors in our community to really dissect this. We're talking about high interest savings account ETFs. This is a huge part of the market right now. I'm sure most of our investors out there might be holding an ETF like this or know someone who's holding an ETF like this. And in fact, there's almost $30 billion in assets in Canada in ETFs that are high interest savings account ETFs or HISA ETFs. But we have seen a new regulation come out, Matt, and I would love it for you to break it down. So HISA ETFs are going to be changing in January. So we want to give our audience all the information they need to understand what's going to happen. So Matt, first of all, what exactly is a HISA ETF? I know a lot of investors are using them, but can you actually explain what this ETF is holding? And why has it become such a popular place for investors to put cash?
Yeah, absolutely, Danielle. And it's definitely been a hot topic, definitely something that we've been talking to on a regular basis. And those HISA ETFs have become extremely popular over the last few years. We've seen significant flows into these ETFs, as interest rates have risen and investors have really started to get compensated. In some cases, 5+ yields to sit on the sidelines in cash. It's a pretty good trade-off for a lot of investors. Given what we experienced in 2022, we've seen a lot of investors look to that cash trade, and the HISA ETFs have been a very, very popular choice. So, what is it, taking that step back? Well, it's an ETF that deposits cash in a portfolio of high interest savings accounts. So literally, you are investing in a portfolio of bank accounts. Money within the ETF, it's aggregated and it's spread amongst several banks, often generating a premium yield for the investors of the ETF. The account, that the HISA ETF deposits in is actually no different than the one that you can set up at your local branch when you're setting up a personal high interest savings account. The difference lies in a few areas. So at the branch, your money is CDIC insured for up to $100,000, where in an ETF, each underlying HISA account only provides $100,000 of coverage to the entire fund structure. So investors are not protected in the same way that they would be in a traditional high interest savings account. It is a subtle difference, but it does and it can impact the end investor. So how are investors using these ETFs? Well, they're using it as a substitute for cash, a way to earn a very premium interest rate right now. Again, like I said, in a lot of cases over this last year, above a 5% yield to basically sit on the sidelines. It's a very attractive position. So we've seen a lot of investors use this as their cash sleeve, as their way to sit out the volatility. And that's why we've seen such an influx of assets over the last couple of years with rates rising. It's a very, very attractive trade. And I think right now with some of the regulatory changes, there's going to be some things that investors want to be aware of.
Right. So it's an attractive trade. HISA ETFs have been around actually almost 10 years. But of course, with rates going up and now rates 5+ for cash like securities. They become more and more popular. Lots of asset flows. I mentioned almost 30 billion. So this is going to catch the eye of regulators, and specifically OFSI, who is an independent federal government agency who regulates and supervises financial institutions. They kind of took notice of this because there are all these high interest savings accounts getting opened, and a lot more money flowing into them. So liquidity is now becoming scrutinized or an issue. So Matt, can you explain exactly what OFSI was reviewing and why there was such a review around these types of ETFs?
Sure. So, with anything, with the rise of interest and assets into these HISA ETFs, several market participants began asking questions about the structure, what are they investing in, and what the potential impact of the the impact to the overall financial system would be, and then what are the potential risks that they could pose. So OSFI began an industry-wide consultation earlier this year to gauge the wide-ranging impact and what these ETFs could have on the financial system as a whole. Traditionally, a HISA, that account, was seen from a capital perspective as a deposit, making it actually the most attractive form of capital for a bank, as they have the highest ability to lend out those deposits. So the bank viewed these HISA ETFs similarly, or some banks viewed these similarly, as deposits. Since it was considered a deposit, banks, which are almost always looking to add deposits, were willing to pay a premium in terms of higher yields. That's why you're getting such a yield premium on these HISA products. This is how these HISA ETFs were often able to have yields significantly higher than traditional money market or the overnight rate. So some banks were essentially paying up for this need or desire to increase their deposit base. So here's where the problem lies. Retail deposits are traditionally very sticky, making it very attractive capital for banks and for the subsequent regulators that are monitoring our banks. But as institutional capital started flocking to these ETFs, this money can and was or should be considered much less sticky. It's a lot easier for an asset manager to move out, let's say, 500 million in cash and redeem these HISA ETFs than it would be for an individual retail investor like you and I. So this is where the problem lies. If the buyers are not truly retail, they're IAs, they're institutions, maybe they're pensions, then the money in these HISA ETFs really isn't deposit-like or isn't really as sticky as the original regulation had seen. So, and if these aren't deposits, and if the money isn't sticky, then OSFI wanted to ensure that the banks that issued them were properly capitalized and were not inflating deposit numbers and potentially creating a vulnerability in the financial system. So that's what OSFI wanted to determine. What was the impact? How many of these types of funds are out there? And what's that potential vulnerability of the financial system as a whole?
Perfect explanation. I think it's important for investors to really understand that are holding these ETFs, understand what's happening in these high interest savings accounts, or actually how they work at banks. If every single Canadian went knocking on the bank's door tomorrow asking to cash out of their savings accounts, that would create a huge liquidity issue for the banks. This is obviously an unlikely scenario. However, what OSCE is looking at is it actually could be a likely scenario if interest rates went back down to below 1% or quite low, for the $30 billion that are invested in these ETFs to be cashed out, as these ETF investors want to look elsewhere to invest their money. So really important to understand what's going on there, why these regulations are happening, what's kind of going on big picture behind the scenes. So this is going to impact HISA ETFs, the changing in these regulations. This is coming out in January. Matt, what's going to be the biggest impact if I'm an investor and I'm holding a HISA ETF? What am I going to expect happen in January?
Yeah, so, OSFI didn't rule to eliminate or close these ETFs. So it's not that they're going away. They're still a viable product for investors. So there's no going concern risk here. But what they did rule was on the allowable capital treatment by the underlying HISA issuers. So the banks that opened up the savings accounts for these HISA ETFs. OSFI has decided that there is a substantial risk to financial stability in these products, and that there is a high likelihood of near-term large-scale redemptions, meaning that these should not be considered deposit-like funding. It shouldn't be considered retail deposits. They should be considered wholesale funding. And in wholesale funding, that comes with a 100% runoff rate, meaning that the capital in these products is not allowed to be lent out without appropriate capital or collateral. So in layman's terms, banks can no longer consider the assets within the HISA ETFs as deposits, so these assets are now less valuable to banks. So what does that mean for investors? That means that by January 31st, 2024, the expectation is that yields on these HISA ETF products will drop by about 50 basis points. So they're going to be around 4.8 to 4.9%, versus where they were about 5.3 to 5.5. That's kind of where we've seen them range. So, not an immaterial drop in yield. And that these HISA products will no longer be yield premiums to overnight rates or money market. So for a long time, the winning trade was go to the HISA, you get a very similar risk profile, but you're getting a yield premium. Now these are going to be likely a yield discount on a go forward basis. So, that's a material impact to investors. That is something that investors need to consider, that if they had income needs, where are they going to capture that 50 basis points from? So, the expectation is we do expect to see yields slowly come down, but January 31st, 2024 is the date where we would expect all those HISA ETFs, as they currently stand, to be about 50 basis points lower in yield than their previous levels. But again, this isn't necessarily a liquidity issue. It's a yield story. You're still going to be able to get in and out of the products. The products are expected to continue to run. There's going to be markets made, but the yield or the investor expectation of the product should come down by that 50 basis points. So investors who were using these products to maximize their yield will likely be forced to do that in other products moving forward. And I think the alternatives of what we've seen thus far is, money market ETFs and short-term fixed income will now offer investors a yield enhancement to HISA ETFs. And that's why we're seeing a lot of investors looking to make that potential switch.
Yeah, thanks for mentioning. I want to talk to you about money market and short-term fixed income. But before I do, I do want to highlight what you said. If you are holding a HISA ETF, do not panic. Your ETF will continue to trade in January. There is liquidity there. What we're really trying to let you know is the treatment of the underlying holdings is going to change, and that is going to affect the yield on that ETF. And therefore, it won't be the premium yield in the cash-like world of ETFs that investors were used to seeing. So money market funds and now money market ETFs, this historically, Matt, has been the place for investors to park cash. Can you maybe describe what is a money market ETF? How is that different from a HISA? And then what would a yield look like on an ETF like this?
Yeah, absolutely. So, money market funds and ETFs have been around forever. And, it is, so at BMO, we offer ZMMK. It's our BMO Money Market ETF. It provides investors with ultra short-term cash-like exposure, and it invests in money market securities. So things like T-bills, Canadian, provincial, commercial paper, bankers' acceptances, under 1 year bonds. So instead of investing in savings accounts, these are investing in actual securities, money market securities, ultra short-term securities. So the fund tends to be about a third of have a term of about a third of the year, and you're getting that very, very similar, extremely liquid cash-like exposure. This is generally, historically, where investors would go with their cash allocation into these money market funds. Money market provides investors with a yield right now of about 5.25 to 5.3%. So that's going to be about a 25 or 30 basis point yield premium to what the expected HISA yields will be in Jan 31st, 2024. So, you're getting that additional yield from money market. You're getting, generally it's about 20, 25 beeps above overnight rate. So for investors, this should be a consideration for investors who are using a HISA, and they're using a HISA specifically for yield, because it's a very similar, if not the same, risk profile. And given this OSFI decision, we are definitely seeing investors making that switch now, not taking any additional credit risk, but saying, look, I was originally in the HISA for the yield. Now the yields come down, so I'm going to move over to something like a money market and pick up that, some of that yield that I've lost. It's not the entire 50 beeps the expectation is going to come down, but you're getting back 25 or 30 basis points, which is most of it. You're getting 50 to 60% of that yield back with the same risk profile. For those investors who have US dollars, there's also US money market or US ultra short term or cash management ETFs. We have just launched one, ZUCM.U and ZUCM. That's our BMO US dollar cash management ETF. That provides exposure to US T-bills, all with under 1 year to maturity. And it's going to maximize investors' yield, basically finding that T-bill part of the curve where it maximizes yield. Right now, you're getting about a 5.45% yield. So, pretty attractive on the CAD dollar side and the US dollar side for investors to move those HISA assets over to the money market side.
And that's the beauty of using an ETF. As markets change, regulations change, investors can quickly and easily react. They can be nimble. You can open up your online brokerage account, make a trade if you need to, if you'd like to maximize that yield, move out of a HISA into a money market ETF, or if you're looking to kind of juice up that yield on cash-like products. Matt, outside of money market and high interest savings account funds, what other options do investors have to kind of keep risk as low as possible, get into something really liquid and cash-like, but also something with an attractive yield?
Yeah, so outside of money market, the other alternatives would be, potentially for those yield hungrier investors to consider a more credit focused product. Like, for example, ZST is one of our most popular ETFs on our shelf. So ZST, it's the BMO Ultra Short Term Bond ETF, and that's the Canadian version. We also have a US version, ZUS.U. That's the BMO Ultra Short Term US Bond ETF. So both of those provide investors a yield premium because we're investing in high quality corporate bonds. So rather than just focusing on kind of T-bills or more government exposures, you're kind of moving up the credit curve a little bit, down the credit curve a little bit, adding some credit risk there, but still a very high quality portfolio. You're getting high quality issuers that all mature within a year. And for the yield hungrier investor, you're getting about, on ZST, you'll get about 5.6% yield. For ZUS.U, you're getting a 6.2% yield. So definitely big time yield premiums versus the new yields of a HISA. You're getting about 40 basis points more than a traditional money market. And at the end of the day, you're taking a little bit more credit risk. But again, because the maturity is so low, that credit risk is minimized. So, you're talking about a 55% bank or financials exposure. The Canadian banks, knock on wood, but I don't think that they're going to be defaulting within the year. So you're getting a high quality portfolio. You're capturing a very, very attractive yield. And I think for investors who care about yield, who are used to maximizing yield and reducing risk, ZST is an excellent on the risk return spectrum. On top of that, since most bonds in the universe are actually trading at a discount to par, so they're trading under $100, and we're going to own these bonds to maturity, there's actually significant after-tax benefits from owning short-term corporate bonds versus money market securities or something like a HISA product. So, and we're talking the differential here for after-tax investors of about 1.2% on average right now. So, if you're talking about a yield of 5% and you're saying after tax, ZST not only has a higher yield by 60 beeps, but you can add 1.2% in terms of additional after-tax return. It's a winning trade, and I think it's very, very meaningful in this market. So we are regularly talking to investors that are considering moving to money market, and then other investors who are very comfortable with a little bit more credit risk because they want that yield in the short end.
Great point about where are you holding these cash alternative ETFs. If they are in a non-registered or a taxable account, remember the 5% or close to around 5% you're getting is interest income. And that is taxed less preferably than other types of income. So thank you for highlighting ZST and understanding those discount bonds and their more preferential tax treatment. Matt, this is a great discussion, really important information. Thanks for breaking it down for us and our audience.
Thanks so much, Danielle. I was happy to.
You don't want to miss next week's episode. So we have Kathy Wood sitting down with us. You might know her from ARK Invest. We are going to be talking about investing in disruptive innovation. Check us out next week for that episode.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.